Liquidity concept. In this video, I won't just explain this powerful trading concept. I'll also show you high win rate strategies used by professionals, explained in such a simple way that even a beginner can master it and apply it successfully on any market, whether it's Forex, crypto, or stocks. Welcome to Graph Insight. Today you will learn what liquidity really is in the market, how to identify liquidity on the chart, and how to trade high win rate strategies built around this concept. If this topic is useful to you, make sure to like the video and subscribe to the channel. First, let's clearly define what liquidity actually is. Liquidity is an area on the chart where pending orders are concentrated. Buy orders, sell orders, and stop losses. Now imagine this. You place a buy order here or a sell order here. By doing this, you are creating liquidity at these price levels. And you're not alone. Millions of traders place orders every single day, which means liquidity exists at almost every price level. So you might ask, if liquidity is everywhere, why should we even look for it? That's a fair question. And here's the key idea. Our goal is not just to find liquidity. Our goal is to find where liquidity is concentrated the most. Let me show you how this works. Imagine you spot a double bottom pattern on the chart. 99% of traders decide to buy at the bottom, expecting the price to move up. They enter long positions and place their stop losses just below the lows. This creates a huge pool of liquidity below that double bottom. So here's what happens next. While most traders expect the price to go up immediately, large market players, such as institutions, banks, and funds, already know where those stop losses are. And they need to absorb that liquidity to fill their own large positions. So before the price moves up, they push the price down. They collect liquidity by triggering those stop losses. Only after that, the real move begins. The logic is very simple. Large players cannot enter the market the way retail traders do. They need volume, they need liquidity, and they need counterpart orders. If you learn how to identify liquidity zones and trade them correctly, you put yourself in the top 1% of traders. The traders who move with smart money, not the ones getting trapped by it. Now let's move to the strategies. In this video, I'll show you 2 liquidity-based strategies that perform best in real market conditions. We'll start with the first one. This strategy works best on lower time frames, 5 minutes, 15 minutes, and 30 minutes. It's simple, clear, and highly effective. The strategy is built around 3 steps. And the first step is identifying a break of structure. Before we continue, let's quickly remind ourselves what a break of structure actually means. As we know, price can move in an uptrend or in a downtrend, but price never moves in a straight line. Instead, it moves in waves, creating highs and lows. In an uptrend, price forms a sequence of higher highs and higher lows. Every time price breaks above the previous high, that's called a break of structure. It confirms that buyers are still in control. The same logic applies to a downtrend. Price forms lower highs and lower lows. And every time price breaks below the previous low, that's a break of structure to the downside. This confirms that sellers are still in control. Now let's look at this on the chart. Here we can clearly see a sequence of higher highs and higher lows. Each break above the previous high creates a new break of structure, and these consecutive breaks tell us that the market is in a clear uptrend. Now let's move to the second step, the liquidity level. The idea behind this step is very simple. After price has formed a break of structure, we look for a level that price has reacted to at least 2 times. A level where price was clearly rejected. This tells us one important thing. Liquidity is resting below that level. And because liquidity attracts price, there is a high probability that price will eventually move toward it and sweep it. At this point, a logical question appears. How far is price most likely to move before the reversal happens? Where exactly should we look for entries? And this brings us to the third step, the fair value gap, also known as FVG. Let's quickly remind ourselves what it is. A fair value gap is a 3-candle formation with a visible gap between the wick of the first candle and the wick of the third candle. This gap tells us that price moved aggressively in one direction due to a strong imbalance between buyers and sellers. In other words, there were significantly more buy orders than sell orders in this area. And because of that imbalance, price often comes back to retest this zone before continuing the move. Now let's move to the chart and put everything together. We have already identified a break of structure and a liquidity level. The next step is to look for a fair value gap between the liquidity level and the most recent major low. And as you can see, we have a clear fair value gap exactly in this range. Here's how we execute the trade. We mark the fair value gap. We place a buy limit order at the upper boundary of the fair value gap. A buy limit order is an instruction to the market to open a buy position at a specific price level. The trade is opened only if price reaches that level. If price does not return to this level, the trade is not open. The stop loss goes slightly below the fair value gap, and the take profit is set at 3 times the stop loss distance. This gives us a risk-to-reward ratio of 1 to 3. With this ratio, we can stay profitable even if our win rate is below 50%. And as we can see, the setup plays out perfectly. Price taps into the fair value gap, respects the zone, and then moves exactly as expected. Now let's look at a downtrend scenario to make this concept even clearer. On the chart, we can see a clear sequence of lower highs and lower lows. Each time price breaks the previous lower low, it creates a break of structure. This confirms that the market is in a clear downtrend. After the most recent break of structure, we can see a level where price was rejected 2 times. This gives us a strong indication that a liquidity level has formed at this area. Once the liquidity level is defined, we look for a fair value gap within the range between the previous major high and the liquidity level. In this scenario, we can see that 2 fair value gaps have formed. When this happens, we always focus on the largest fair value gap. This is usually the zone with the strongest imbalance. Here's how we execute the trade. We place a sell limit order at the lower boundary of the selected fair value gap. The stop loss goes slightly above the fair value gap, and the take profit is set at 3 times the stop loss distance. This keeps our risk-to-reward ratio at 1 to 3. And as you can see, price respects the fair value gap and moves according to our scenario. The setup works exactly as planned. At first glance, this strategy might seem complex because it requires multiple conditions to align. But with practice, you'll be able to recognize these setups very quickly, even if you're a beginner. Now let's move on to the second strategy. This one is a bit more advanced. You won't see this setup as often as the first strategy because this time we're trading a trend reversal. But when this setup appears and is traded correctly, it can deliver even bigger profits. This strategy works best on higher time frames, the 1-hour chart and the 4-hour chart. Just like the first strategy, this one also has 3 steps. But instead of looking for a break of structure in step 1, we're looking for a change of character. So let's quickly explain what that means. In an uptrend, when price breaks the previous major high, we get a break of structure. That tells us the trend is continuing. But when price breaks the previous major low, that's called a change of character. And it signals that the trend may be reversing. The same logic applies in a downtrend. If price breaks the previous major high, that also creates a change of character. Now let's move to the chart and see this in action. Here we can see a clear uptrend. Price is forming higher highs and higher lows, creating multiple breaks of structure. This confirms that the market is bullish. But then price breaks the previous major low. This creates a change of character. And that's our first signal that the trend may be shifting. After the change of character, we can see price forming a liquidity level, a level where price reacts 2 times. Just like in the previous strategy, our next step is to find a fair value gap. This time, we look for it between the previous major high and the liquidity level. Once we find it, we're ready to plan the trade. We place a sell limit order at the lower boundary of the fair value gap. The stop loss goes slightly above the fair value gap, and the take profit is set at 5 times the stop loss distance. This gives us a risk-to-reward ratio of 1 to 5. Now let me explain why this higher risk-to-reward is justified in this case. When a market reverses direction, trading volume usually increases much more than during trend continuation. Because of that, price often creates strong liquidity zones. And once those zones are created, there is a much higher probability that price will move toward them. On top of that, this change of character was formed after a liquidity sweep above the previous major high. All of these factors combined give us the confidence to target a 1 to 5 setup. We can also manage this trade in a more conservative way. For example, we can split the take profit into 2 parts. Close half of the position at a 1 to 3 risk to reward. Then move the stop loss closer and let the remaining position run toward the final target. As you can see, price hits the first take profit. We adjust the stop loss, and later, price reaches the second take profit as well. Even if price had failed to reach the final target, we would still remain in profit because the risk was already reduced. This is why understanding market structure and liquidity gives you a real edge. You're not guessing. You're following what the market is actually doing. Let's also look at the opposite scenario to make this strategy even clearer. On the chart, we can see a clear downtrend. Price is forming lower highs and lower lows, creating multiple breaks of structure. This tells us that sellers are in control. Then price breaks above the previous major high. This creates a change of character, and that's our first signal that the downtrend may be ending. After the change of character, price starts to slow down, and we can see a liquidity level forming. This is a level where price is rejected 2 times. At the same time, a fair value gap forms between the previous major low and the liquidity level. Now we place a buy limit order at the upper boundary of the fair value gap. The stop loss goes slightly below the fair value gap. The take profit is set at 5 times the stop loss distance. We also split the position. Half of the profit is taken at a 1-to-3 risk to reward ratio. Here's what happens next. Price pulls back into the fair value gap. Our order is filled. Price then moves up and reaches the first take profit. At that point, we move the stop loss closer, reducing risk. And later, price continues the move and reaches the final take profit. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.